This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks, and welcome to Money Talk. Here's a lineup for today's show. We start with Dave Sally, who is with the Ottawa Business Journal, and then we go to Kevin O'Leary, who's chairman at the O'Leary Financial Group, and he comments on Aritzia, the retailing group, and its impending IPO. After the break, John Heffernick, who's a professor of biology at San Francisco State University, comments on the phenomenon known as zombie honeybees. And then to my weekly chat with Matt Hendricks. And after the news, Simon Weber, lead portfolio manager, global and international equities at Schroders. After a break, we go to Catherine Murray and conversation with Andy Bush about Donald Trump's latest campaign overhaul. And to conclude the show, Andrew Bell talks with Randy Smallwood, who's the CEO of Silver Wheaton. But first, to Dave Sally of the Ottawa Business Journal. Well, it's great to be joined by Dave Sally from the Ottawa Business Journal today on Money Talk. How are you, Dave?
Not too bad, John. How are you?
Well, I'm feeling we're getting to the end of the summer, and that makes me slightly uncomfortable.
Well, yeah, it's bound to happen, though, I guess.
Well, it's been a great summer. Now, Dave, Invest Ottawa's co-chair, Dave OBJ, an update this past week on the search for its next CEO, while Shopify announced its plans to raise big money through selling treasury shares, and one of the city's fastest-growing companies added a heavy hitter to its executive team.
That's right, John. Well, let's start with the latest on Invest Ottawa and its search for a new CEO. The city's main economic development agency is on the hunt to replace former boss Bruce Lazenby, who stepped down earlier this summer after 5 years at the helm. David Ratonja, who co-chairs Invest Ottawa with Mayor Jim Watson, recently chatted with OBJ about how the search is progressing. He said more than 100 applicants from across Canada and beyond have already thrown their hats into the ring. He said some really good names are coming in. He said global executive search firm Boyden, which is handling the file, is expected to whittle that number down to a more manageable long list by the end of the month. Mr. Ratonja said ideally the agency would love to land someone with a, quote, rock star name, unquote, who wants to give back to the community. He added the successful candidate will need to have plenty of business acumen and will also need to be able to work well with other business development groups in the city, like Elspark and Sengen. A 9-person hiring committee led by Mr. Ratonja expects to make its final decision by early October. The next CEO will be ushering in a new era for Invest Ottawa, which is, of course, moving to new headquarters in the much-anticipated Innovation Centre at Bayview Yards when that building opens in mid-November.
And, Dave, the good news continues for Shopify, which announced a major share sale this past week.
Yes, John, that's right. Ottawa's e-commerce darling said Wednesday it will raise about $246 million through the sale of 5 million treasury shares. The offering will also see Bessemer Venture Partners, which was the lead investor in Shopify's Series A investment round in 2010 and also participated in its Series B and C rounds, sell another 2.5 million shares along with several Shopify executives. The proceeds of that, more than $123 million, will go to the selling shareholders. In total, 7.5 million shares in the Ottawa-based firm will be offered. The shares will be priced at $38.25 U.S. The company first announced its plans to conduct the offering in late July, but didn't announce the pricing until this past Wednesday. The company plans to use the proceeds to strengthen its balance sheet so it has more flexibility to fund its growth strategies.
Well, that's a great Ottawa story.
Absolutely.
And finally, another high-profile local tech company boosted its leadership team this past week.
Yep, that would be software firm U.ITV, which announced it had hired its first chief operating officer, and that person is a well-known name in local tech circles. The new COO is Dan Beer, who was previously the managing director of IBM's performance management division in Ottawa. He'll be responsible for helping to support growth at U.ITV, which develops interfaces for user interface frameworks so developers can build TV apps that work on mobile devices, tablets, and smart TVs. The company said Mr. Beer will help accelerate product development at U.I TV so the company can scale to meet the needs of its growing customer base. U.I CEO Jason Flick said the new COO has a keen understanding of software products and a history of building relationships with key sales partners. Mr. Beer spent 6 years at IBM and worked at Cognos before that. He brings experience in a variety of fields, including sales, operations, services and support, and performance analytics. U.I, of course, is becoming a pretty well-known name in the Ottawa tech community. It made OBJ's list of fastest-growing companies the last 2 years, and among its customers are Sony's Crackle, Rogers' Show Me service, Chorus Entertainment, and Turner Broadcasting.
And Abe, what's on the OBJ radar for the coming week?
Well, John, one of the hidden gems, so to speak, in Ottawa's growing makerspace scene is hosting an open house next Saturday. Makerspace North covers 19,000 square feet and features an industrial workshop, a startup incubator, and a community hub among its many amenities. It's located at 250 City Center, Bay 216, and it's welcoming the public to come and celebrate all the movers and shakers who make it work this coming Saturday from 10 a.m. to 4 p.m. Events will include 3D printing demos, robotics demonstrations, and plenty of activities for the kids. For more information, go to makerspacenorth.com.
Well, that's a great update. Thank you so much, and we'll look forward to talking again 2 p.m. next Sunday, and enjoy the rest of your day and have a good week.
Well, you too, John. Thanks a lot.
Now to Kevin O'Leary, chairman of the O'Leary Financial Group.
Women's fashion retailer Aritzia has filed for an initial public offering on the Toronto Stock Exchange. And since Hydro One's massive offering last year, Canada's IPO market has ground to a virtual halt. Joining us now for his take on Aritzia and the IPO market in Canada is Kevin O'Leary, chairman of O'Leary Financial Group. Kevin, good to be with you. Interesting to take a look at Aritzia and the fact that they're going to go public. What do you think it's going to take for them to be successful in the public markets?
I think the deal is going to be well received, but not by institutions. I think the bankers, and I'm not even looking at this deal because it has a dual voting class share, which for me, it doesn't even make it investable. But let's just look at it from the context of the bankers. They feel it's been so lean and mean out there, so few IPOs, that maybe they can get this one done with more of a retail investor base. There'll be some percentage of institutions, and I'm guessing when I give you this percentage, but maybe it's 35, 40%, that won't even take the meeting because their corporate governance doesn't allow for dual voting class shares. Because you've got to remember, long-term investors like institutions, pension plans, sovereign funds, have gone through the Magna and the Bombardier disasters of dual voting class shares, so they simply don't participate. But, most retail investors, and I don't mean this to discount their value, don't really get hung up on this issue, and they don't really read the prospectus anyways, and they may be more trading oriented. Long term, it'll make it a less stable stock. You're going to see a lot of volatility with this because it's not going to be in long hands. It's going to be traded. Mm-hmm. They made, in my view, a huge mistake making this dual voting class. What it tells you is that maybe up to 70% of long money isn't even going to look at it.
Why do you think that they've gone down this path then? And how will it negatively impact the retail investor?
Well, it's always riskier to own a dual voting class share because you can get held up at gunpoint like Magna was, or you can have incompetent management continue to just do the same thing over and over again like we have at Bombardier. Just look at the stock chart of Bombardier sometime and realize that not some of the people, all of the people that invested in that, including institutions, lost all of their money all of the time. So that's what can happen. That's the downside of a dual voting class share. I don't see the benefit ever for retail investors. I don't see the benefit for any investor, which is why I avoid it. If anybody asked me about this stock, I would simply say don't buy it.
But, Kevin, when you take a look at some of the big tech companies in the United States, they do have dual class share structures, so there can be a case for a successful strategy here.
No, you're right, and I'm not saying it won't be well received, but if you're asking me long term, the outcomes can be pretty bad. Google's a good example of a success, but you're going to find a lot more failures than successes in dual voting class shares, which is why many corporate investors, through compliance mandates, have decided just not to invest in them at all. I think the company was misguided by its bankers.
That's what I wanted to ask you.
There's nothing proprietary.
Yeah. I'm wondering why.
There's nothing proprietary about what they do.
Yeah.
Because I think when a banker is starving and they have to turn rocks over to find some protein to eat, which is what's happening in small banks in Canada right now. There's no IPOs. They haven't had any protein in 6 months. There's no oil and gas companies going public. There's nothing going public. So all of a sudden you get a live one like this. You'll say anything to get the deal.
So
Kevin, remember, they're not going to. This is what you're asking me what I think. I think in normal times you would have never got this deal done.
Well, but that's not even the question. I mean, when you say get the deal done, you're saying convince the CEO or the owner or the founder of the company to take it public. And so the way that the investment banker, if I'm hearing you correctly, is getting this deal done is by saying to the founder, don't worry, you can keep control. We'll just do a dual class share structure for you. That's what you're saying.
Yeah, that's what I'm saying, because the company asked for it and said, look, can we get it? You always ask for at the end of the day, is it the right thing to do long term? I'd argue no, but if you can get it done, and because you got to remember, there's probably 5 competing banks trying to get a piece of this thing and get their fee. They haven't had any protein in a year. They're starving under their desks. They'll say anything to anybody to get a deal done. I'm sorry, that's just basically what's happening. But is it good for shareholders? No.
Okay.
It isn't. And so you should think about that when you buy this stock. I'm not recommending it. I'm not buying it. A dual voting class Canadian retailer? You got to be kidding. That's like, in my view, a personal opinion.
Yeah.
That's a C-grade stock.
Well,
what shouldn't I forget?
What you shouldn't forget is the fact that they've had a lot of success moving south of the border, that they do attract the aspirational female millennial, which is one of those key areas that everybody wants to target and attract, and a lot of people fail at, and they're succeeding at it, and that's the fundamental story, and that's a positive story. If you're
social media, no, I'll look at it this way. There's nothing proprietary with what they're doing. They're executing well. They're good that way, but that doesn't mean it's a good stock. Remember the nature of fashion. I don't have to tell you this, Catherine, because you're very fashion forward. You know that these trends come and go. You can have a great cycle with a Lululemon and a Gap and then have disaster. There's lots of volatility. What will make this stock more volatile is a dual voting class share. A Canadian retailer with a dual voting class share is not going to get a lot of traction in the United States. And that's just the way it is. That is a C-grade stock, in my opinion.
They're really going to have to track some small-cap growth managers.
Let's go to a break, and when we come back, John Heffernick, professor of biology with San Francisco State University, and he's going to tell us about a threat to the bee population. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Of being a bee these days, we're talking about fungal diseases, parasitic mites, pesticides, loss of habitat, and now there's the threat of parasitic flies. Now, flies are known to use a host to lay their eggs inside. Yellow jacket wasps have often been a target, but now researchers have discovered that honeybees are becoming infected in a phenomenon that's called zombie honeybees. We are joined now by John Heffernick, professor of biology at San Francisco State University. Thanks so much for coming on the show, Professor. Could you just describe what this fly does and what's happening with honeybees?
Sure. What this fly does, and it's a very small fly, smaller than a fruit fly. The female flies will find a foraging honeybee, land on her abdomen, and then puncture the abdomen with a structure called an ovipositor, which is like a hypodermic needle, basically. Insert eggs into that bee, and then the eggs will hatch in a short time into fly larvae, which are maggots, and those maggots start feeding on the inside of the bee. Now, along with that, the bee's behavior changes, which is really significant. The bees begin flying out of their hives at night when they're parasitized. And this is not a good thing for a bee to do, especially in northern climates like Canada. And then they'll get attracted to lights nearby, wander around in kind of a zombie-like fashion, thus the name zombies or zombie bees, and eventually die with the maggots feeding on the inside of the bee, almost cleaning the inside out, then emerging right about here between the bee's neck and the rest of its body. They sort of erupt from that area, slither off, and form little brown pupae. But this is like the chrysalis of a butterfly, and it's within that pupa that the adult fly then develops and emerges, flies off, and finds other bees to parasitize.
Now, this fly has attacked in the past wasps. I suppose nobody really cares about the poor old wasps, and wild bees, bumblebees, but now it's apparently spreading to honeybees.
That's correct. So this is a native fly that has hosts in native bees and native wasps like yellow jackets and bumblebees, but it's now increased its host range to include the European honeybee, which was brought to North America in the 1600s by the colonists, and has become one of our most important pollinators of agricultural crops, backyard crops, and also, of course, an important producer of honey for us as well.
So in nature, you do get this zombie phenomenon where the parasite actually modifies the behavior of the host to suit it. It's not 100% clear, though, whether this leaving of the hive at night actually helps the fly or if it's just a kind of an unintended effect.
That's correct. At this point, we don't know if the fly is actually modifying the behavior of the bee by affecting its neural system and its behavior in a way that helps the fly. Perhaps the bee flies out, dies in a place that's good for the flies to pupate, and then form these adult flies later on. It could also be that the bees are getting away from the hive to protect their hive mates in a way so that they die away, and it's less likely that the flies reinfect bees from the same hive. Essentially altruistic suicide.
That's
and
it.
We know that bees do a lot of altruistic behavior, and these are the two main hypotheses that we're trying to test to see what's going on here.
Yeah, that's interesting. Altruistic, of course, if a bee stings to defend the hive, it kills itself is probably the best known thing. Now, an outfit has been set up called Zombie Watch, and it's pretty serious. It's not about fictional zombies. Tell us what that's about, please.
Zombie Watch is a citizen science project that we've set up to try and find out how widespread this phenomenon is in honeybees especially. And so we're asking citizen scientists across North America to be looking for honeybees that are acting strangely. And by acting strangely, I mean coming to lights at night, wandering around in circles on sidewalks or driveways or places like that. And then visit our site, zombiewatch.org, take our tutorial, which will tell them how to take samples, upload photographs of what they're seeing, and help us understand how widespread this problem is for honeybees. So far, citizen scientists have been really doing excellent work. They've come up with a variety of discoveries along the West Coast that we now know that this phenomenon occurs from Santa Barbara, California on the south, north to British Columbia with the most latest finding. And we know it's occurring in the eastern U.S. as well, from Vermont, New York, Pennsylvania, and most recently from Southern Virginia. In terms of the fly itself, we know the fly is distributed from the southern United States all the way up into Alaska, almost to Fairbanks. So it could be affecting honeybees virtually anywhere within that area, including most of Canada.
As if the honeybees didn't have enough problems. Thanks so much indeed for joining us today, Professor.
Been a pleasure. Thank you.
John Hafferdake is Professor of Biology with San Francisco State University.
And now to Matt Hendricks. Well, I'm joined by Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management. Hi there, Matt.
Hi, John. How are you today?
Pretty good, thanks. Thank you for joining us on this rainy Sunday. We've had an incredible summer, but the farmers need this rain. I hope that you're having a good weekend.
So far, so good, John. Up at the cottage yesterday and just back in town today trying to stay dry.
Now to the markets. There's an old saying used by economists: if you forecast an event, don't give a date, because inevitably you will be embarrassed, because economic events are impossible to nail down exactly. We do know that we are in new territory for interest rates and that central banks around the world are pulling out all the stops. The no inflation scenario is a mirage concocted by statisticians who are probably on drugs. In my opinion, all investors should be considering a diversified defensive strategy, particularly at this time in history. Now, I noticed an article in Barron's this weekend entitled "Why Alternative Mutual Funds Are Better Than ETFs." And I think it's a must-read for all investors, and it really speaks to the Sprott philosophy and strategy and products. Now, what is your prescription for listeners, and what do you have in your kit bag in terms of strategies?
Well, John, as you say, the markets, equity markets are at all-time highs. Interest rates are at all-time lows. Very, very scary time to be in the markets. You know, you've got elderly people or people that need income being forced into the equity markets, chasing dividends, running up the cost of these stocks to buy. And, you know, of course, the answer to your question, simply as we've been talking about, is you have to be diversified, and you have to have managers that are active, nimble, and have the ability to play defense like we do at Sprott with our enhanced equity product that has built-in defense in case markets go down. Scott Colburn running our fixed income platform that can go long, short, global, and more importantly, our alternative investing. Alternatives these days, John, worldwide have grown from the average of 10% of our portfolio to north of 40. And in Canada, we're starting to see the investment advisors really understanding what these alternatives can do. And when we say alternative, a regular fund or a regular strategy is usually always long only. You buy the stocks and you hold them, and you go up and down with the tides. But an alternative strategy can actually take advantage of markets when they go down, and they can do certain things that your regular mutual fund can't. And you definitely have to have a talented, experienced manager running those funds, which we have at Sprott.
Well, when we talk about ETFs, we're talking about passive products that don't have those characteristics, that flexibility. They're basically buying the index, hugging the index, but it doesn't take care of the unforeseen events. And, of course, during recent years, some of these random events have happened in clusters.
Well, for sure, John. Just for example, this year, you know, the Brexit interest rate decisions by the Fed. We've got the U.S. election coming in the fall. Problems in Europe, problems in Africa. Things can pop up anywhere, which will cause what Nassim Taleb calls the black swan. And if you're in these passive investments, I mean, we say that buy and hold, that used to be the way to go, but we think that buy and hold is dead. If your manager doesn't have the ability to sell on a dime and make a shift in their asset allocation, then you're just going to go down with the ship. And ETFs, although they are for the most part low cost, there's a reason why they're low cost. You get what you pay for. And alternative investments, we believe, are the future, and that's why we have been there for a long time, and they've been really adding value to our clients' portfolios.
Well, of course, listeners and advisors can always call you to learn more about these strategies and pick your brains. And I wonder if you could give us your coordinates.
Definitely, John. I'm always reachable toll-free at 1-866-299-9906. And always remember to visit Sprott.com.
Well, that's a great update. Thanks so much for joining us, and we'll talk again next Sunday, 2 p.m., and have fun.
Cheers, John. Always a pleasure having me on your show.
Okay, folks, stay with us. After the news, we go to Simon Weber, who's a lead portfolio manager, global and international equities, and he is in conversation with Andrew Bell of our affiliate BNN. And you are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
We are joined by Simon Weber, lead portfolio manager, global and international equities at Schroders. Simon, great to see you.
Yeah, good morning.
Not a dramatic sell-off or anything in European stocks today, but they are under pressure. Why the negative tone?
You know, I'm not sure we have a kind of very specific driver for today. You know, clearly there are some focus on US kind of interest rates over the last couple of days. The bank sector is leading Europe lower today, and there continue to be concerns around the Italian banking system. That, you know, is well discussed that there needs to be a solution to recapitalize the weaker banks in Italy and clean up some of the problem loans. That continues to be worked on in the background, but I think until there is a resolution of that and they find a way to inject money into the banking industry there, the whole European banking sector will remain under some pressure.
Simon, it's Miles. Do you, when we're talking about the banks here, and do you think, one of the weights or the counterweights on the European markets have been the performance of the banks? Do you think that it's going to remain that way in the sense that European markets can't really get going until, like broadly speaking, until we get some clarity on, the bank situations, whether it's profitability, capital, etc.?
Yeah, I think that will be a really crucial factor, there's no doubt. And there is a time frame for that now. The referendum on a new constitution in Italy is likely to be the end of November. And really before that date, there has to be a resolution on the Italian bank sector. And the question is really whether or not there is the bail-in of certain types of bond and other parts of the capital structure, or whether the government can inject capital, a bit like the US did with TARP in the financial crisis. And, when that happens, it will represent a very important catalyst if they can do that successfully. And if not, then it continues to kind of bleed confidence in the banking industry. But I think, our view is there is a lot of value and a lot of upside in some of the better capitalized European banks when we deal with this uncertainty issue, which is really focused on Italy.
Is there any sense, do you think European investors would accept a contention? I think some people in North America think, well, US took decisive action on its banks and got the bad stuff off, whereas the Europeans have been much slower to actually bite the bullet, to use that cliche.
Yeah, I think that's a completely fair assessment. We should not still be dealing with Italian non-performing loans 6-7 years after the financial crisis, and we are. And it's well known they need to reform their resolution process. It takes years and years for banks to recover their money on defaulted loans, and there has been a lot of just kind of lies from certain of the banks about how bad their balance sheets were, and they've been slow to clean that up. So at least now there is a sense of crisis and an urgency to deal with the problems, which could be a very important clearing event.
Simon, just to switch gears a little bit, one of the big topics over the last several weeks has been the impact of Brexit. And, a lot of the macro surveys have come out and shown that maybe the UK might come under some economic pressure as a result of Brexit, but yet you get some of the data that's been pretty strong. What's your view here of the stronger than expected UK data? Is the economy holding up? Do you see it holding up on a go forward?
Well, our own internal economic forecasts have come down clearly since pre-Brexit, and I think for next year we expect the economy to grow a little under 1%, whereas consensus is more closer to zero, no growth. We're not that concerned, but clearly a slowdown as investment, decision-making, companies are being more cautious and they want to see what the solution for Britain outside of the European Union is going to look like before committing long-term capital. But there have been some important positives. Tourism has already jumped, I think it was up 18% just in July. So that's without people even having time to plan summer holidays. So I think we should expect a boom in tourist arrivals next summer. So there will be parts of manufacturing clearly is going to get a big boost from the weaker pound. And a very interesting piece of information came out recently that just shows the housing market. London and parts of Britain that voted to remain, there has been an impact on confidence and housing market has weakened. Parts of the country that voted to leave actually have been seen quite buoyant housing market activity, which is interesting. It tells you that consumers who voted out are reasonably comfortable.
Globally, if you had to put money into an equity market or a region right now, what's looking best, Simon? Asia, North America, Europe?
I'm spending quite a lot of time, and our team has been finding a lot of ideas in Asia and other emerging markets. There are clear improvement stories, likes of Brazil, where they've been in a terrible recession for 2 years now, and you can see the improvement, the pent-up demand, the improvement in confidence coming back from a very low level, but improving, and that dynamic's often very powerful. But also Asia, there are economies like India that are just powering through 6-7% real GDP growth, over 10% nominal. That's great, just great for the top line of companies operating there. and even some signs of stabilization around the kind of North Asia, Greater China area as well, instead of this relentless slowdown we've been experiencing for the last 2 or 3 years. So, Asia's already improved in performance terms, but I think it still represents a pretty interesting fishing ground, and we're finding more stock ideas there than we have in the last few years.
And just finally on oil, just looking at BP's ADRs in North America right now, they're yielding almost 7%. Do you think there's any danger for investors who rely on the BP dividend that management might just say, we're in a new era, we're going to have to cut it? Or does Shell, BP, are their dividends sacrosanct, sacred for now?
I can't speak to BP very specifically, but in general terms, Shell would be in the same boat where their dividend coverage is negative at the moment. These companies need a recovery to $70 oil, $65, $70 oil to generate enough cash to sustain dividends at that level. So, we are going to need a further recovery from $50 over the next couple of years for those dividends to be sustainable. They are not sustainable if we kind of have a $40 to $50 new range for oil. So I would think about it like that.
Simon, thank you so much for joining us. Have a great weekend. Simon Weber, Lead Portfolio Manager, Global and International Equities at Schroders.
Okay, folks, after the break, Andy Bush, who is in conversation with Catherine Murray, and they will be discussing Donald Trump's latest campaign overhaul. And then on to Randy Smallwood, who's the CEO of Silver Wheaton. Stay with us. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Donald Trump has overhauled his campaign yet again, reportedly firing his campaign manager for imposing too much message discipline. Trump's new right-hand man, the head of the provocative news outlet Breitbart News. So why has Donald Trump appointed a media firebrand to run his campaign? For these details, we're bringing in Andy Bush, joining us now. Andy, pretty amazing. He's doubling down on essentially what he's always been doing. He didn't want to be somewhat controlled or changed.
No, I think that's right. First of all, let me just correct you. They did not fire Paul Manafort, but it certainly looks like he's taken a big demotion. The effect is the same, is that Bannon from Breitbart has been a big supporter of Donald Trump. He also hired Kellyanne Conway, who is a big Republican pollster. So a couple of takeaways here. One is that, yes, he's definitely doubling down on what brought him to the dance, right? And that is his populist, anti-immigration, anti-trade, law and order kind of vibe that he has, hitting that populist message. So that's for sure in his bailiwick. That's what he's going to go after. But then also with Conway, I think they're going to focus a lot more on Hillary Clinton as well. So those are the two angles that I'll think that they'll really go after. And it's interesting because Trump could not do what Manafort was asking him to do, which was stay on message, go after Clinton to some extent, and really broaden the argument to draw on independence.
What's been the reaction?
I think this is Trump 2.0. Clearly, he needed to do something. He was down significantly in the polls after the convention. So if he had brought Manafort in to handle the convention and that went poorly, then he has every right to fire the guy and move on or demote him. So we'll see what happens. Trump has got a narrow window here. He's got about 6 weeks before the debate. And I think it's critical for him to narrow that gap with Clinton. He's got to cut it in about half. He's down 6 to 7 points. So we'll see in the coming weeks how this plays out.
So it sounds like he's going to go back to his original messaging from the very start, which is why he had attracted so many people and got as far as he did. And he's going to really just double down with this new person on the team.
Yeah, it really gets at the heart of the middle income earners in the United States and the pressure they've been under for no increase in their wages. And what's interesting in the news today, obviously everybody's been talking about Uber and buying auto, but also Uber coming with driverless cars to Pittsburgh. And I think what's interesting about this is it shows the march of this technology is going faster than everyone really thought could happen. And I think what's really the telling component of this is what are they doing? They're replacing drivers. Why do they want to do it? Because it's the most expensive part of what Uber does, right? And if you can take out the human driver and replace them with a machine, well, you can cut your costs significantly. You don't have any healthcare costs. You don't have to follow the mandate. You don't have to go to lawsuits in California over whether the drivers are independent contractors or whether they're employees. And this is broadly happening not only in the Uber section of the economy, but also in McDonald's, also in agriculture. I mean, you go down the list, in big data, AI is all trying to get at how do we replace repetitive labor and also human beings. And this is what I see, and that's what's compelling about tying these two together. I mean, this is the rise of Sanders and Trump addressing really unhappy middle-income earners in the United States.
Back to Bannon for just a moment. He is a former investment banker. I'm just wondering how he might use any of his experience to either help or hurt the Clinton campaign.
Well, we know we're going to get more emails released. We know we're going to get more voicemails, DNC stuff that's going to be leaked out from WikiLeaks. So they're going to use that to their advantage. We know the State Department's going to release more emails from Hillary Clinton as we lead up to the end of the campaign. So they'll have a lot of material to work with, and they're going to hammer this really hard and very aggressively. So I'm not sure what his investment banking component of what that would do for him. Looking at her, maybe some of the donor lists.
Well, I would think that and just even her relationship with Wall Street.
Yeah, I mean, it's kind of hard to paint that one. I mean, Trump is in New York City, and he's got a lot of relationships with investment bankers. Clinton, obviously, the Clinton Foundation is probably, her Achilles heel as far as being trustworthy. I think that's part of it. Benghazi, State Department emails. These are the two most disliked or unfavorable candidates we've ever had in the United States. So while Clinton is ahead right now, you never know how this could flip.
Quick look here, just to pivot for one moment. Any reaction from you on the Fed minutes yesterday?
Yeah, I mean, they were a little bit more dovish than I thought they would be, but given San Francisco John Williams' report that came out saying that the Fed should raise its inflation target just a day before that really set the groundwork for what I think the Fed's trying to do here. They're really trying to thread the needle. They realize that the economy's doing okay in the United States, and it's doing okay enough to raise rates, but the rest of the world is not doing okay, and that's one of the big problems. So I think one of the ways they get around not raising rates is by raising the inflation target, and they kind of stay in this will they, won't they mode through September. My guess is they'll raise rates in December if they're going to do it. They'll just keep putting it off as long as they can.
Right. All right, Andy. Good to see you. Thank you.
Now, to conclude today's show, we go to Randy Smallwood, CEO of Silver Wheaton, in conversation with Michael Hainsworth of our affiliate BNN.
We're off to Vancouver now to speak with Silver Wheaton's Chief Executive Officer, Randy Smallwood. Randy, good to have you with us again.
Michael, always enjoy it. Thank you.
So you're going to ever catch up to Franco-Nevada here as far as valuations are concerned? You're underperforming, yet you've got all of these assets that are comparable.
Well, actually, I would argue, first off, we focus on our business, and I'm not chasing anyone by any means, but I would argue that our portfolio, it's first off, we're 100% precious metals, and second off, in terms of quality, we really put a lot of focus in terms of ensuring that our assets are the most profitable ones out there, and I would put our portfolio up against anyone in the precious metal space, not just the streamers.
How do you go about doing that? How do you go about keeping those costs low and the returns high?
Well, it comes to being very selective and being very thorough in terms of your due diligence, but being selective in terms of which assets you choose to invest into. One of the criteria that we focus on in any of our investments is where does that mine fit when we invest into it? Where does it fit on the respective curve? If it's a copper mine, we want to make sure it's in the bottom half of that copper cost curve. If it's a lead zinc mine or a nickel mine, the same thing, the bottom half of that cost curve. And well over 90% of our production, and this is, we got 24 different mines delivering metal to us, and well over 90% of our production comes from the bottom half of that cost curve. So it's a very high quality portfolio. These are the assets that our partners love investing into, and when they do, we reap the benefits of that with our partners.
Is the rising metals pricing a bit of a double-edged sword for you, making it a little more difficult to get new deals done, yet at the same time bringing in more cash?
Well, we don't go on the philosophy that we should continually always bring in new deals. There's only certain times anytime you're dealing in a commodity that's got cyclical pricing, you don't want to be buying all the time. You only want to be buying near the bottom, right? And so the way we look at it, and it's one of the reasons that we use debt. We've got a revolver. It allows us to gives us capacity in the bottom of that cycle, and we'll step out and make these acquisitions. And if the price climbs, if the trends continue going, yes, it's going to be tougher for us to make accretive acquisitions for our shareholders. But I tell you, our existing shareholders will reap the benefits of that increased cash flow. I think I started out this year forecasting about $400 million in free cash flow this year. Now we're estimating up over $800 million in free cash flow this year. That's the benefit. It might be tougher to get deals done, but the benefit is, of course, that increased cash flow.
Seasonally speaking, we're entering a strong period for gold, but to your point, where are we on the longer-term cycle here for you that you see down the road, the one that gives you the opportunity to open your wallet again?
Well, there's two ways we open our wallet. It's making new acquisitions, and then ultimately, as we strengthen up our balance sheet, the other way is to add to the dividend side. And so that's something that we would look at with higher prices. That's the direction we go. We continue to build up that balance sheet, build up a healthy war chest to move forward, and then at that point we would consider raising the dividend. The last time we increased that dividend, we already have a dividend that's tied to our cash flows, and what that allows us, our shareholders to do is get the benefit of these higher prices directly. But in terms of that percentage, right now we give 20% of our cash flow. That could easily climb when we see higher prices, and so it's going to be one path or the other. My feeling is we are going to see higher prices here in the near term. I don't see too many indicators. In fact, I see nothing that's going to go negative against precious metals over the near term.
All right, we'll play my mugs game as we looked at the price for gold and silver for that matter. Both of them from a technical nerd's perspective like myself, they seem toppy here. A double top is a bearish formation, not a bullish one. Why do you expect continued growth? And again, what's your targets?
Well, as long as we choose to measure gold and silver in U.S. dollars or in any fiat currency, and if you look around the world, it doesn't take much to lose confidence in the capacity of central banks to keep value within within those fiat currencies, and that's where when I look around the world, I see continued pressures on central banks and on governments to try and stimulate growth, and quantitative easing is let's call it what it is, a spade. It's printing money in an indirect form, and as long as that happens, people will be looking for a store of value, and the challenge that everyone has is to try and find a place to save value, and that's what we're seeing in precious metals right now. Is I think it's a start of a trend of having a real lack of faith there, and so that strength is just going to continue building.
All right, I didn't hear any numbers in that answer though, Randy. Gold, $1,600 this time next year?
I usually give forecasts, but I tend to don't put times on them. But I could easily see that. $1,600. We've been up as high as $1,800. The last time our shares were at this price, gold was trading around $1,700, and silver was up over $30 an ounce. And so, I can see how much our company has grown since then, and that's hence the share price, at least in Canadian dollars. I can easily see $1,600 gold. I can see silver up over $25-30. One of the other sides that doesn't come out is the fact that we usually invest into developing assets, and I don't see any money going into the ground. Most of the opportunities we see right now are just funding balance sheets and taking care of debt. And if there's no new mines being built, then you get supply side pressure. So there's all sorts of factors that support the price of precious metals.
September 29th is going to be a very big day for you with your Analyst Day. The Street wants to hear you pound the table on what you've already got and how you're going to improve what you have. To you, though, what is the biggest thing you want to focus on at that meeting?
Well, September 29th is also my birthday, so we're going to celebrate a bit more than that. We're looking forward to that. It'll be our first ever Analyst Day to come into the Toronto crowd and sit down, and we're actually going to have some of our partners coming in and telling the story, which is, I think a bit unique, but, I just think again, it's the quality of our portfolio, it's the strength of our portfolio, it's the fact that it's 100% precious metals, and just the opportunity, the upside that we see in these assets. It's just trying to make sure that people understand, the foundations that we've built into this company and how well that positions us to continue moving forward.
Randy, thank you for your time, and in advance, happy birthday.
Thank you very much, Michael.
Randy Smallwood is the president and CEO of Silver Wheaton.
Well, that's it, folks, for Money Talk. Thank you for joining us. We'll be back next Sunday, 2 p.m. Hope you have a good week. I'm John Budden, and you are listening to 580 CFRA.